questions for you, but I know you've been
I
waiting
know,
for a
man.
while,
Sorry,
Arma. Yeah, sorry to
we
interrupt
were
you,
too
Simon.
busy.
Arma,
We were
yeah.
too busy debating, so we didn't realize you'd come on. So apologies. So the question to either one of you then is, and it might be a bit of a repetition, but I'm pretty sure we've got a lot of new listeners now, and in addition to that, we've got new speakers on the panel. But the first question is, obviously we've heard what's happening to Swiss Bank, and the concern is that this, and we know that there's been moves to make sure that this doesn't cause a problem, but people in Europe have told me that there are concerns in various European states, such as
Yeah, yeah.
Italy.
Let me, Simon. Let me read this out to you. Actually,
Okay.
to give you an exact quote relative to this question, Sulaiman, to show the concern, because we did have panelists before, and very smart panelists that I'm always humbled to have, kind of express that this is expected, and they're not too concerned about this being a contagion. But let me read the following: Karen Petrou, who's a managing partner at the Federal Financial Analytics consulting firm in Washington. She said she expects Credit Suisse will be rescued by Switzerland. Okay, that's fine. If Credit Suisse were to fail, you would see significant problems. All sorts of exposures would come unglued. So that particular point, all sorts of exposures would come unglued. This is the systemic, the contagion risk that I think should be addressed a bit more. And I just have the feeling, I just don't have enough knowledge as all the panelists who have had over the last few days to kind of give specifics, but I just have the feeling, and Stock Talk will be back with us shortly. He's off on a call, that there's more risks and more leverage than we give than we think. I think we're just feeling a bit too complacent. But obviously, I could be completely wrong. So maybe to get your perspectives, Robert, we haven't talked with you. We've been here talking about Silicon Valley Bank's failure. Armand as well, but we haven't gotten your thoughts, guys. Sorry to take your mic, Slyman. So I apologize, man. But actually, Slyman's question will be about the same, I think. Your thoughts on Credit Suisse and the response, the swift response by regulators, offering support.
No, it's a great brings up a great point about European versus U.S. regulation on the institutions, but also on the deposit levels. And it's been in a great space all day. I've been popping in and out. Robert Wolf was really excellent. I maybe he couldn't talk directly about a direct competitor, but if he were to tell you, UBS was far better run. I might not agree with all his policies, but that institution was far better run than Credit Suisse. So the real question is, how many, Europe has an even more pronounced problem with continued QE, with rates that have gone up, where their portfolio there is probably underwater, about to take some hits. I don't believe they have a big relative U.S. portfolio, particularly in deposits, that would cause a deposit contagion concern. And I looked over the top 25 U.S. banks. You're talking about 11 trillion of total deposits. There's not much that are in insured deposits. Probably 2.5 trillion of insured deposits. There's no way we should be doing whatever we just did with SVB was a mistake on going to help insured deposits, so resolve them quickly. They could have been resolved by working them out. Maybe they would have got 70, 80 cents on the dollar for uninsureds. We cannot do that for Credit Suisse U.S. deposits. We should not. There's only 100 billion left in the FDIC fund to do that. They just raided 25 billion out of it to get it down to under 100. So no, no, it's not. It is a problem with Credit Suisse. It's a European problem. Let Europe do it. Let them bail out the European side of it, not U.S. depositors paying for their mistakes. These are specialized mistakes. SVB was a super concentration of risk in a sector, in a sector that is a Ponzi scheme. When you're raising money for startups, guess what? They don't have any profits. The only takeout is that next IPO, right? So when the IPO market seizes up, there's no takeout. They draw on their lines. They max out SVB. SVB has to go chase hot money deposits like they did last year. And guess what? They offered fat yields to get that. They get those deposits. I'll disagree with Robert Wolf on this. You know, you don't. What caused SVB was them running for hot money, paying up deposits. Guess what? That hot money also goes out just as fast as it comes in, and it did last week with 42 billion going out. So This is kind of a mess. I don't think we should be creating new systemic problems by rating the FDIC thing. Let the market prevail. I have to I have to basically, congratulate the rest of the responsible banks out there. Of those 11 trillion in the top 25 deposits in the U.S. banks, they're managed really well. There's a couple maybe teeny ones, Bank of China, that are playing games, but all of them are really well run and can withstand the financial malpractice that the Biden administration has brought on them and the Fed has brought on them. They can handle write downs on their long term book. And that's just one leg of the three-legged stool. They have capital, but SVP quickly ran out of capital. Credit Suisse might be quickly running out of capital too.
I mean, the argument from a number of speakers, and I think Robert made the argument, although don't quote me because I could be wrong, but they said that this, well, they're not calling it a bailout, so stopgap that's occurred is specifically for these two banks, and then they're not going to do it for other banks. So won't that alleviate the problem in terms of the FDIC not being able to back it up?
It depends on the
There's a couple
stopgap.
things
What's
here.
the stopgap they're proposing in Europe?
So
So in Europe, sorry, so I was talking about SVB there, but in terms of Europe, it's not. I mean, it's not actually United States who's come in to help support the Swiss bank. Or correct me if I'm wrong, but it's actually Swiss National Bank, isn't it? So it doesn't really have that much to do with the US.
Yeah, let Europe come up with their backstop. They have some kind of facility, or they're doing extend and pretend really well. They've been doing it for years, doing that. Let them do it with Credit Suisse over there. We don't want it to impact our stable U.S. banking system.
Okay, so I mean, I'm not sure about this, so I'll ask you: are you aware of any connections Swiss Bank has with American banks?
Oh, they all have exposure to each other. Like that's
in terms of exposure.
any bank anywhere in the world really has exposure to others. And Armand, you got a lot of background noise. I know you want to jump in. I'll give you the mic. Just a heads up. I've muted you a couple of times because you got a bit of background noise. But yeah, like there's something that for anyone, any bank failing within the system will have we're a globalized economy, so we'll have impact on other banks. So if the Swiss bank, Credit Suisse, is not bailed out, it's going to heavily impact the US banking system and vice versa.
Sure.
Again, if I get it wrong, please do correct me. But Armand, I'd love to get your thoughts on this.
Sure. Can you guys hear me okay? No
Yeah,
background
man.
noise now?
Yeah.
Okay, cool. So there's a couple things. One, U.S. Treasury currently is reviewing this bank's exposure to Credit Suisse, but from what they've seen so far, it's not huge. It's more of the concern that, if it destabilizes across Europe, of course, it's going to hit the United States. But I want to respond to a couple things Robert said. I don't think it's an accurate characterization of how Silicon Valley Bank went under. What happened actually is that they had a ton of big IPOs and their deposit rate went up really, really fast. But most banks, when they have a lot of deposits, they make money in the short to medium term by doing loans. The problem of startups as a business for a bank is that they don't really do debt finance equity. They do primarily startup, they don't do debt financing. They probably do equity financing. And so they didn't have a big book of loans. And so they put way too much money in these long-term mortgage-backed securities and T-bills. But it's not an issue that they were actually, the vast majority of the deposits that were uninsured didn't even have interest bearing. They're not chasing yield. They're just depositing the money there because for a lot of different reasons why it worked for the Silicon Valley ecosystem. But their fundamental issue wasn't something about chasing yield. Their fundamental issue was it's not like a bank that is set up in a lot of traditional ways because the industry they support is one that doesn't need a lot of loans. And so they made a bad bet on long-term interest rates. The second thing I wanted to mention on...
Sorry, on the bad bet for long-term interest rates.
Yeah.
In hindsight, the CEO is getting a lot of criticism. Again, the background noise, Armand. But in hindsight, the CEO is getting a lot of criticism, and rightly so. But the risk, compared to the risks that banks took in 2008, it's incomparable. I think it's a stupid risk. It's irresponsible, fair, but it's not a risk that depositors will take into consideration when considering to deposit their money in FDIC. In Silicon Valley Bank. So I don't see the argument, and I don't want to get back to that discussion because we've discussed it a lot. The argument of Again, I would never call it a bailout because you're supporting depositors, not shareholders. I think it's a weak argument.
So
No, 100%.
So-
And part of the issue is that if they didn't stop them, it would sort of cause more bank runs, and eventually the FDIC would have to pay out more for that. And so this is actually like the cheapest thing for the FDIC. And if a sale happens, which I still expect it to in the next few weeks, the FDIC is not going to pay anything. So, like, 100% agree
Exactly.
with you.
Robert,
so,
do you disagree?
Yeah, I totally disagree. So, we have an insured deposit system here. The banking institution assets there's many that are, we only have 2.9 trillion of insured deposits. The top 25 banks have like 11.5 trillion of deposits. So there's a lot of uninsured deposits in the system. And FDIC cannot, they don't have enough capital. They didn't even have enough capital for the insured deposits. They were underwater. So they needed a bailout even before this happened. And now they're getting hit with 25 billion. So now their net assets now are 100 billion. So they're already weakened. We couldn't even handle another, 100 billion before the thing is wiped out. And guess what? The taxpayers then have to bail it out. Right now, the depositors are bailing it out because the Fed said, or the FDIC said, we're going to sock everybody with new deposit insurance premiums. It's not going to be like generously donated by bankers. Bankers are going to pass through to depositors. So, and back to the loan portfolio, I think Armand, interesting point about what you're thinking, but I think the proof will be in the bidding. I guess the contention is that the loan portfolio wasn't that bad, and it was a debt maturity thing with the long-term bonds. Yes, they did have a $1.8 billion hit from trying to time out and sell off their debt investments. Those are the most liquid. They had to go to the first liquid investments to sell in order to meet the $42 billion of deposit outflows. They're not going to get any liquidity out of the $75 billion of loans they made. My contention is those things were not cash flowing. If you want to look at the bidding that goes for the whole bank of SUB, and that's actually a smart move to sell it off in whole. I guarantee you they're going to have some dirty hits in that loan portfolio because those things are not cash flowing because the IPO market did seize up. There's no takeout there.
No, I agree on that, but the bigger issue was just that it's a small percentage of the portfolio in general. That's why they had all these treasuries and mortgage-backed securities. Is that
right.
They didn't actually have that much debt that they could issue because startups.
Oh no, it's not the debt issuance. Their asset side was loans and investment securities. They tried to issue debt and equity and failed in that. So there's some kind of a little effort to try to fix up the problem that we actually don't really know about. There's nothing public about it, but that failed. And they couldn't issue debt. They couldn't issue equity. So the only other option left to the FDIC is try to shut it down. Their first move was protect the insured depositors, 75 billion of them. And then when that news came out, the local street out there freaked out and said, "Oh my gosh, my uninsured depositors aren't going to be protected. We need to be protected." Well, guess what? It just pushes the pain to everybody else, and it's private gain and social losses, and that's not the fundamental premise of the FDIC.
That's fundamentally not how the FDIC works. Like since 2008, post Indy Mac, the informal policy of the FDIC is to recover 100% of deposits, which they've done 91% of cases for 95% of assets. Because after Indy Mac, they saw that there were a bunch of cascading potential bank failures when they didn't make depositors whole. Under least cost provisions in the FDIC's charter, they argue that would cost them less on balance. If we already saw that Signature Bank went under this weekend, the Fed and Treasury really worried about bank runs. If you had a bunch of bank runs and you said, I'm only covering FDIC insured, that would still, but you have 10 bank runs, that's going to bankrupt the FDIC faster than saying, we'll backstop you now, prevent a bunch of bank runs, not spend any money.
And that's a fair point, Robert. Go ahead. I'll let you respond. Then maybe Jason, as a former FDIC capital markets regulator, it'd be good to get his thoughts on this. But go ahead, Robert.
No, so that's That's mostly right. Thank you. That the FDIC has worked out everything except IndyMac. Now, but that shouldn't be the implied policy going in. They first have an obligation to the insured depositors, and then thankfully they try to work out and resolve the rest of the assets. And if you have a properly structured bank with 15% capital, assets should be, 100 and 117% of the liabilities, right? So you got that first buffer. The first buffer is there for a reason, as the skin in the game that should cover the risk activities of the bank. And then thankfully, if you lose 15% of your assets, then you still can pay all the depositors and the liabilities back. But for some reason, FDIC said that's not going to work out. We were thinking their first initial thought was give them a 50% coupon on Monday, and then they work out the rest, and maybe they get most of it back. But the key thing here is they would have to work it out over time. I did several big FDIC workouts, right? And it's a time element of earn your way out. They could have done that here, but for political reasons, there was such a hissy fit about it. They said, let's not let SVB work itself out over time. Everybody's so concerned. Let's accelerate the workout, and let's give up all the uninsured depositors 100% coverage right now. And that is irresponsible the other way.
I want to, Robert, just quickly. I want to go back to the Credit Suisse discussion with reading out 2 minutes ago that came out. Not too surprising, but large U.S. banks view Credit Suisse exposure as quote manageable. Obviously, not surprising to see such statements, but maybe Trevor or Robert, Armand or Jason, anyone could give our thoughts on the impact of the Credit Suisse turmoil on the U.S. banking system.
Yeah, I think one of the things that it hasn't been necessarily talked about is the absorption capability of these loan portfolios. I mean, Robert and I were on a panel with Grant last night, and I think one of the things that we haven't focused on when you look at risk exposure, that's one thing. When you look at duration risk, that's another. But the asset repricing is happening because we're raising rates, right? Like we're sucking liquidity back out of the market. So inevitably, what's happening is confidence in banking systems, because you're not earning what you could on other asset classes, is starting to become an issue for several banks that bought loans or were anticipating assets or loans that they thought were going to be held to maturity to rotate back into AFS or available for sale, because of the fact that the majority of these the Fed hikes over the years are cuts in our quantitative easing system has basically proven out that we do not have the type of infrastructure from a financial banking system to handle these types of swings from an interest rate policy perspective, right? Like it's kind of baffling to me that we're not talking more about how real estate has seen the gains that it has, how certain startups and valuations have seen the gains that they have. And to kind of not assess really the fact that interest rate hikes and the cost of capital going up is not going to impact asset classes and the value decay of those assets that we've seen for the last 10 years is kind of interesting. So I think with Credit Suisse, obviously, the more that you saturate the market with these loan portfolios that have to be sold at a fast rate, right? We haven't seen anything like this before. I mean, like 2008 was its own dilemma, but I think the speed and the velocity of how contagion is spread, especially in the financial, fear, fear sells obviously, but I think in this case, so many people are so much more in tune to the risk on, risk off process on like an hourly basis. And I hesitate to kind of speculate where being naive to the fact where it's like, oh, okay, like it's manageable risk. Everybody's at risk, right? All the banks are always at risk because they have to loan in order to make any money. So the fact of the matter is that I think a lot of the banks are trying to kind of curtail the media narrative or the impact by saying, all right, look, like we've got this under control. Sure, but if you had a run on your banks and everybody wanted to hide their cash under pillows, which doesn't make any sense, not saying you should do that, but if that were the case, you wouldn't, no bank would be able to survive a quarter of their deposits being pulled. So I think it's kind of this false narrative of saying, oh yeah, like SVB was kind of one in their own. If you had a quarter of your deposits as a bank pulled in 2 days, you would have significant issues, regardless of if you were JP Morgan or SVB or a regional bank, right? So I think these are the specific items that the velocity of fear, I think, is going to drive more of a narrative. And when people start seeing volatility like we've seen in the markets the last couple of days, and see headline news of banks collapsing, whether they know what the intended purpose was or not, I think consumer sentiment is not like, oh, yeah, we're going to go out and buy a Mercedes tomorrow because a bank imploded, right? It definitely has an impact to the way that consumers have confidence in the marketplace, which also drives the underpinning for the confidence for those loans to be, economically sound, if you would. So,
Trevor,
Trevor,
can I ask you a question there? I feel, and I've asked this question multiple times over the last few days. It's not with the fractional reserve banking system, we're no longer discussing leverage. We're discussing leverage is still important, but we're discussing it's a game of confidence.
Yep,
that's the priority. I think what the FDIC's number one priority should be consumer confidence or depositor confidence, followed by how healthy or toxic the balance sheet of a bank is, and we saw that in 08 as well. I just don't think, you can't look at what happened in 2008 and the balance sheets we saw in 2008 and compare them to what we saw with Silicon Valley Bank. Again, correct me if I'm wrong, but we can't compare them with Silicon Valley Bank. But what is similar is that the run on the bank we had in Silicon Valley Bank is insane, and it's very weird as well the way that VCs kind of either triggered it or did not, kind of calm the fear. And that's what this is what concerns me the most. This is
go
ahead, Robert.
Brand new Wall Street Journal headline that just dropped here. United States threatens to ban TikTok if Chinese founder does not sell ownership stake. So that just hit.
There we go. I've been calling it for a long time. We did spaces on this.
About time.
Who would have thought?
Sorry, guys. One second. You've also seen that the Pentagon said that aliens might be sending probes to the Earth this evening as well, because they
want to change it. They want to change the subject.
Where's all our money gone? And they're saying, "Look, aliens!"
But I think to your point, Mario, this is absolutely a.
Can you send me?
question.
Sorry, Trevor. I would love you to answer the question because this is like my main question over the last few days. But I don't want to be rude. Stock Talk, can you pin it above or send me the? Oh, there it is. You've pinned it above, so I'm gonna check it out. That's. I mean, do you think it'll be banned or they'll? Sorry, Trevor. We'll get back to it. But do you guys think the founder will sell? I think he's forced to sell the stake rather than face a ban. That's just fascinating.
Hold on, just quick question, guys. The aliens, how good are their banks? I'm looking to put some money in.
I heard they're pretty insolvent. Yeah.
In Trump administration, we had them. They had some deals to line up a new owner, so maybe that the TikTok ByteDance would get out of it and find a different owner. So those discussions were ongoing. They'll just fire those up again.
Yeah, but now they're threatening. Did they threaten a ban or no?
I think they've been
That's what the
ratcheting up
headline
the pressure.
is. I haven't read.
No, not now. I'm saying whether that happens. If you can include the article in the headline, Stock Talk, I'd love to have a look.
Yeah,
at
I'm
it.
trying to get the article right now.
But back to your point, Mario, and so the fractional reserve system is great, but the key part of that is the real first line of defense in the banking system is the equity layer of the bank's capital, regulatory capital, and that's been really strong. The banks are doing really well. They still, they've got 15-16% equity capital, and that's enough to withstand the mark to markets that we've seen because of rapid interest rate rises and the adverse effects on the investment portfolios. The banks can all handle that. The SVB had other double and triple whammies on their book that are unique. Credit Suisse has different unique characteristics there. So, but what the two tools are, if the bank regulators wanted to manage the tools and capital and the fractional reserve system, they could change the reserve requirements. Say, hey, dudes, you need more backstop. Frontline backstop by changing reserve requirements. That's one. Or they could actually get the banks to raise more capital, either indirectly, like we did in 06, 07, 08, where the banks were saying no dividends, no stock buybacks. That can support capital. And just one other kind of salacious political thing I want to throw in here. Why was SVB giving away $73 million to BLM last year? That could have supported $1 billion of deposits. Just stupid stuff that SVB was doing. It was part of the problem. it's unique to that bank.
You know, Mario, I think you hit upon it with saying, is this just a confidence game? And I think to, Robert's point, there's this idea of how they try to work out these deals. And it was, very, very odd for the FDIC to ever say, hey, we're going to protect the insured depositors on like a Friday, transfer all the money to that, deposit insured bank, and then transfer it to the Silicon Valley Bank NA, this new bank on Monday that's now open, and they're going to protect all the depositors. I mean, the core FDIC mission is to protect, the insured depositors. That's always at least the way I understood it when I worked there. But what is interesting when you say, it is a confidence game is the FDIC is really trying to figure out what's going to just make people calm down and not put money in their mattresses. And I don't know if you already talked about it in this room, but it was released, I think, a couple hours ago on Politico that they've hired Piper Sandler as their investment bank to sell SVP as a whole unit. And I think that's a very interesting point because that's really what the FDIC is trying to do now. They want to sell it. Now, interestingly, this came from some lawmakers who said they had 4 deals from 4 different banks that did an auction